Good morning and welcome to the March Market Update. I'm Sean Hannigan, CEO of Aurora Capital. Well, March seems like a lifetime ago now. I've been in financial markets since 1985 and have experienced some pretty unusual market environments. But to be honest, what we're experiencing at the moment is definitely unique. The current market environment is totally self-inflicted. Recent job and inflation numbers coming out of the US have been reasonably positive and mostly ignored by the markets because of the massive instability caused by Donald Trump's tariff policies. As a seasoned investment professional, I'm finding it very difficult to try and predict what's going to happen over the next few days, never mind the next few years. Well, equities pulled back in March as concerns around geopolitical tensions, growth and inflation weighed on sentiment. The US S&P 500 index declined by 6%, led by a sharp sell-off in technology stocks. The so-called Magnificent Seven shed 21% from the December highs, ended the quarter down nearly 16%. The NZX 50 also declined a much more modest 3%, whereas European equity markets fared slightly better thanks to the continent's new fiscal direction and investor rotation out of the US market. In the US, Federal Chair Jerome Powell struck a more cautious note, leaving open the possibility of a rate cut and signaling concerns of a slowing growth. That has now changed to concerns about inflation. But anyway, this led to a drop in 10-year Treasury yields, which ended the month at 4.2%. European bond markets responded to the region's new fiscal agenda, jumping with the German 10-year bonds surging with a single-day increase of 30 basis points on March 5, which is the largest jump since German reunification in 1990. Look, we expect to see ongoing volatility while Trump is in his dealing mode. We were surprised at the randomness and level of tariffs imposed on April 4, but thankfully most were later deferred for 90 days. With the exception of China, where we have seen tariffs increase to nearly 150%, and that's just not sustainable. However, as I said earlier, how this all plays out is anyone's guess. So we're making sure we have a well-diversified portfolio to attempt to mitigate drawdowns. We remain defensive, but we'll look to invest more into equities and ongoing market weakness. Thanks for your time.